Welcome to Hedge It Forward. Are zeros really worth what they're cracked up to be? The short answer is yes. Let's dive in. This is not financial advice. Using zeros is a way to generate income. I'm going to show you how to use zeros, not over leverage, and use them as cash secured and to generate a pretty decent income. I'm going to use IWM, which is small cap stocks. So a lot of times we use S&P. There's other ETFs that you can use, but I'm going to use IWM because it represents the markets, the Russell 2000 stocks. So it's a very big basket, but it's all small cap stocks. So they are rate sensitive, and there's some nuances that you need to know. But the requirement is much, much smaller than SPY. So we're going to use one IWM position, cash secured, take up to $25,000 at its current price. You got to do this in 100 share increments. We are going to sell a 50 delta, which is an at the money 0 DTE on day 0. So today, we're either going to let it expire or we're going to let it get assigned. The very next day, if it gets assigned, we're going to sell a 30 to 40 delta covered call. And then we're going to let it expire or get called away. If our 0 gets expired, we're just going to do it again the next day until we get assigned. The whole point is we're going to use our cash and put it to work, going back and forth between getting it called away, getting it put to us, and then selling premium on options. And as if though we're buying that stock anyway. If we're going to buy it, why not do this strategy? And we're going to rinse and repeat. Margin requirement is $24,500 at today's dollars. Let me show you how this works. All right, so I'm going to go back to December. Let's go back to the end of November. And for every day, I'm going to sell either a put or a call, and I'm going to get it put to me and let it get called away. So here we go. On November 24th, the stock price opened up at 236. So what that means is I'm going to sell a put 236 because I'm selling a 50 delta. And this is executed in the morning, so 3 minutes after market opens. This particular day, the market closed at 240. It expired, collected $105 worth of premium. The next day, market opens up 241. I sold a put for 241. 82 cents, let it get expired because it closed higher. Next day, market opens up at 244. Sold a put for 245 because it's 50 delta, probably 2 or 3 minutes after open. Price moved up a little bit and it expired. So I collected another $91, so on and so forth. So for these days, I collected $358 in premium. Stock keeps going up. December 1st, 245.71, sold it for 246, and it gets assigned to me because the stock closed at 245. So in this 5-day period, $466 worth of premium. I now own it at 246. So I'm $24,600 in at this point. Next day I sold, 247. Opened up at 247, sold a 248 because I'm selling a 40 delta, got my 40 cents. Nothing happened. It closed below that. So I collected that premium. December 3rd, same thing. Opens 245, sold a call at 246, and this time it went up to 249. While I missed out on the upside, doesn't matter. I'm not looking for all this upside potential. I'm looking to collect this right here. So that's $580. Stock got put to me at 246, got called away to me at 246, and I made nothing on the stock but $580 on the premium. All right, so going through, that's the intuition. That's how it works. So then the very next day, we sold another put, collected $100, it expired, sold one, got signed at 251, and then sold calls, 3 days worth of calls, and look at the premium I collected there. So all in, that is $400 worth of premium, and I get put to me at 251, got called away at 252, so made $100 there. Now, this is the multiplier, so I'm showing you it's per share, so it's $1 per share or $100. This is a $100 move. So I put it into this because it's a multiplier. It's the way option contracts work. So I sold it for $1.32. It's really $132. So anytime you see these 59 cents, 68 cents, whatever, multiply by 100. All right, so that's the intuition. So you can see where it gets assigned, call away, assigned, call away. Some days I lose on the stock, $450, but I've collected all this premium. Let me go back, switching gears. Why this works actually a little bit better than the 30-day VIX. So you may have heard of a covered call strategy. It's where you own the asset and then you go sell for extra income. You sell a 30-day option out, maybe a couple dollars out of the money, and you collect that as additional premium. The problem is it doesn't account for each day's volatility. So here's what I mean. VIX never goes below 11 or 12. And here's the VIX across the bottom. And you can see there's certain days it goes all the way up. If I'm selling a 30-day DTE, I may get lucky. And on that third Friday or that following Monday when I sell my call, I might get $329 for a 30-day covered call, but that's just once, right? Most of the time, I'm only going to be in this range, and I'm going to pick up between $100 to $200, and the VIX will be here. Where one day outperforms is I get a reset risk and volatility every single day. Same thing. Now I've got VIX. Look how many times I was able to sell a one-day DTE when one-day VIX was higher. So 30-day VIX could be even higher than that. But I get to capitalize on this every single day. Intuitively, you can see that the premiums are already better than they were on the 30. For example, here, a VIX 81 is selling for $100 in one day, whereas the other one was what, 300 for 30 days? So you can see the premiums are much, much better, much richer. And the reason for that is if you look at VIX 30-day, the way options are priced is for 30 days, they're looking out exactly 30 days to the second, and they're pricing that. So if you're doing this on the third Friday of every month, which is a typical covered call strategy, you may get lucky and you get this VIX price here. And so this one, sure, you would have collected a decent premium, but then this one, look, if you're on the third Friday here, you get this one, third Friday here, you've got a much lower premium on this day, maybe $100, $200. Take a look at this, fast forward to September, same thing here, but look, it would have been pricing in what was known in known events. And so it would have just priced it at whatever this 30-day VIX was at this point, and you would have missed out on all of this. Because each time this spikes, you're going to get a higher VIX 1D and therefore a much higher premium. And at this time, when it was priced in, it didn't know about whatever this event was. Maybe Trump says something on Truth Social that caused VIX to spike and the market freaked out. Maybe he said something about tariffs or something. That's where VIX 1D outperforms VIX 30. Now here, you would have gotten, this would have been fine. November, it was priced very high for the next 30 days. And so it worked out perfect. But here, not so much. Look at all these extra. If you would have sold here for the next 30 days, look at all this extra premium that I missed out on. So that's why I like the VIX 1D. Now you got to execute right. You got to have good execution. So you got to stick to the plan. So let's say you get something assigned and the stock falls. Maybe it falls 1 or 2%. And you're thinking the next day's covered call is not going to be enough to overcome that. What you can do is sell a 20 delta instead of right at a 30 or 40 delta, which is closer. So IWM is 249 and selling 250 or 251. You may say, if it falls, I'm going to sell maybe at 252, 253 or something higher so that if the stock comes back up, you still get the return of the stock price back to maybe its original position. So what I'm trying to say here is if you sell a 20 delta call, how far out of the money does that stock move? Let's say here for a VIX 50, so you're over 50, the out of the money for that 20 delta is 2.86%, which means the stock has to move almost 3% to even hit the call. And what are the odds that it's going to hit it and then stay above it? Very small. In fact, it's 20%. That's why it's 20 delta. 80% probability of keeping that premium or 20% of it get called away. If you were trading this on SPY, quite frankly, if it moved on that particular day, that's almost 18 points, $1,800 if I was trading SPY. So $1,800 plus the $40 or $50 worth of premium that I would have gotten here, I would take that all day long because the very next day, volatility is still going to be high. Maybe it's coming down. It might come down to 40, but my put premium then the very next day, I'll be able to sell and it'll be extremely juicy and may get $400 or $500 just for that one put. So in and out. So again, I ain't going to let volatility dictate how far out my calls are to generate that income. Let's take a look at the return behind this. So on a 1 day, 20 delta calls on a $24,000, $25,000 investment, you're going to make about 0.16%. That's about a $23, $24 for that position. Well, $23, $24 doesn't sound like much. It adds up. And you do that every single trading day, 252 trading days. And now all of a sudden, you're talking maybe 6,000. Now you're 40% annualized when you take this kind of premium. But if you do a 30-day delta covered call, it's 0.86. So you might sell that for $200 to $300 and you get a 0.86% return monthly or 10.3% annualized. Because again, the options are priced for the known events. Whereas 1D, that event is most likely known and you're getting the premium with all the risk priced in. So it's a much better. Now this is 40% annualized on options itself. not necessarily the stock moves, because we got to take into consideration what happens if the stock tanks and I lose on that because it got put to me. Let's take a look at that. We're going to look at 2025, 2026, one of the worst years for this strategy, because you had some massive moves in April around Liberation Day. And prior to that, just after that, some massive moves up and down. One day, S&P was 10%. That was definitely a black swan event. So if you would have sold that call, you would miss out on all that upside. Absolutely all day long. So we can see that here. So here's the premium. I would have started out, let's say, on a $25,000 account at $0 in premium income. This chart takes into consideration the stock loss or gain as well as the premium. So at its worst, you would have been down roughly $2,500 by April on whatever investment. So if you're doing this on IWM, that would have been down, you'd have been down 10%. If you would have looked at IWM during that same time, it might have been down a little bit more, but you're reducing your cost basis every time you're selling these puts and calls. You are actually reducing it. So while IWM might have been down 20%, your position is only down 10 because you're collecting premium all the way down. Now, when it goes back up, it might take a little bit of time to build back up, because now you've got to sell these puts and the stock might move 2 or 3% in a day. Sure, you're going to miss out on all that upside, but it doesn't matter. You're collecting that $100, $200, maybe $300 a day, depending on the volatility. You're doing that every single day. And so that's what happened here. Stock started moving back up relatively quickly. So in this case, a lot of these would have been expired. And if it got put to you, the stock would have went down and then sold the call the next day. It would have got called away. You collect both sets of premium. And at the end of the day, by the end of 2025, you were roughly $3,000 in profit. So on a $25,000 investment, you'd have been up 10 to, what would have been that, 12%, 13%, and then continue on, and you'd have been on a year. This is all the way up until the 1st of March, $4,000 on a $2,500 investment, 20% return. That actually is pretty much what the market did. But let's go all the way back, 2017. I backtested this every single day, selling puts and calls, 30 and 40 delta calls, 50 delta puts. And from 2017, 9:33 in the morning, or 3 minutes after market open, using real data, this is what your P&L would have looked like on a $25,000 investment. So your CAGR on this is quite high, because on a $25,000 investment starting in 2017, we know that the market was going up. So a lot of those puts were just expiring every single day. Look at January of 22. This is when it stopped, because volatility with the Ukraine war picked up. And then you had tariffs and you had everything else. So you've had a lot of volatility over the last 3 or 4 years with interest rates and so on and so forth. But you would have went from $80,000 at that point to 104, 106, something like that, in just this strategy alone, one contract. Now, there are a couple of different tips I want to go through. IWM, I was showing you this on IWM because you can do this on a smaller account. So $25,000, you can do this. If you're willing to hold small caps anyways, why not do this? 24,500 at today's price, a 1% move. If the market goes down and you get, let's say on 50 delta, you get a $100 premium, but the market goes down 1%, you lose $245 on the stock itself, but you collected the put premium of $100, so $145 would have been the loss on that. So you're just reducing your cost basis. The very next day, you sell a $100 call and you're going to get your premium back. And you have to just keep working it every single day. Small account, use IWM. Bigger account, if you want to use SPY, premium is going to be about twice as much. They move in lockstep. They're very close to each other. IWM has a little bit higher beta than SPY does. But if you want to remove yourself away from like tech, you might use 2 IWMs instead of 1 SPY. But a 1% move on that one is roughly $650. Again, if you get $200 to $300 worth of premium on that day, 1% move down, you actually lose $300 instead of $650 if you had just bought the stock outright. SPX is roughly 10 SPYs. So the market, but requires $100,000 worth of margin in order to do this. This is cash settled, so it does not get assigned to you, which has its own set of risks. I prefer, if I'm doing this particular strategy, IWM or SPY. If you have a really small account, let's say $10,000, you can use an MES future, which is half of SPY, roughly half a SPY, because it's actually the MES future is traded on the SPX. SPY is made up of the same stocks within SPX, but it's off ever so slightly, but it's absolutely close enough and trades very much the same. So MES is half of SPY, which would be equivalent to about $32,000, But because it is a futures contract, the margin requirements are only about $3,000, but you get the same exact exposure as if though you're holding $32,000 of SPY, if that makes sense. So what that means is a 1% down move on that is roughly $325. You can see it's very close to IWM. My recommendation, if you're going to trade a small account, go with IWM. But if you don't have that kind of money and you still want to play this, use an MES, but know that you're highly leveraged. What that means, if the stock market takes 20%, you're going to lose about $6,500 on MES. So that $3,000 investment now is underwater. So you have to be able to put some cash, inject some cash into it if it falls 20%. But because you're trading an ETF, you're trading the market. So it's not the same risk as taking on with a Microsoft or Tesla or something like that. You're trading the market. So you could leverage a little bit if you want to. Again, that's not financial advice. These are just some tips and risks to consider when you're trading this strategy. So I hope this helps. If you want a little bit more information, please let me know. If you want me to break down the model a little bit more and show you a P&L of the actual spreadsheet day in, day out, I can walk through that. But this strategy works. It's called the wheel strategy or a derivative of the wheel strategy. So hope you like this. Have a good one. We'll see you next time.